Well, let's now get further analysis of the federal budget and what it means for investors. David Lane joining us from Ord Minnett. David, welcome to you as we digest some significant changes, particularly in relation to tax and how it affects investments.
Yes, absolutely, Andrew. It was a very large budget as far as CGT is concerned, negative gearing, range of issues that will impact investors, not just in the property sector, but also in the share market. And, really for many investors around Australia will, I guess, may rethink their long-term investment strategy, not only where their investments are held, but also which investments they're actually looking at as well.
Yeah, in fact, do you think this is likely to encourage investors to move from the property sector perhaps into the equity market and also try to filter more into super?
Well, I think all of those things will definitely be the case. That there was obviously a focus on the property sector with the changes to capital gains tax and negative gearing. The changes to capital gains tax will also impact share investors as well. But I think the thing that share investing does is it provides a lot more flexibility. So there is the ability to rebalance portfolios, to make some adjustments, to take some capital losses to offset some of those gains. So I think that there are some benefits there for long-term investors, but I think we will also see share investors making a reassessment of where they're investing. So as you said, superannuation is still the preferred vehicle, and the changes to CGT didn't impact superannuation. So I think it will mean that people will, if they haven't already, be favouring superannuation as an investment vehicle. The other investment vehicles that will be impacted are discretionary trusts, which are obviously used fairly significantly by a lot of share investors as well. So there is a bias. We might well see an increased use of companies for investment vehicles. And coming back to the share market, we may well see a bit of a shift and a bit more focus on dividend and income producing assets and the benefits of franking credits, because franking credits thankfully weren't touched. That may well be another attraction to share investing for long-term investors.
Most immediately, David, do you feel as though there are likely to be some stocks that could come under further pressure?
Yeah, well, I think so. We've seen a lot of volatility this year, and we've seen many of the large stocks like CSL and Cochlear, for example, that have come under a lot of pressure. The tech stocks like WiseTech, Xero, you name the tech stock that's been sold down. So in the very short term, the next month and a half, we could actually see a bit more pressure on those stocks, because people will be looking at whether or not they crystallise those losses. So selling some of those losing stocks now so that they can then use that to offset any capital gains that have been realised, and potentially even carry forward some of those capital gains into the future to offset future gains. So yeah, we could well see a bit more pressure on some of those stocks. The other interesting one will be CBA, because historically CBA has been held by a lot of people, and when I talk to investors, one of the reasons that they don't want to sell is because they don't want to crystallise that capital gain. So given the fact that we are now in a different environment as far as capital gains tax post 1 July, we may actually start to see a few people look at whether or not they sell their CBA shares, or at least some of those, in this financial year, to not be as impacted by that capital gains impost.
It looks as though this budget is going to exacerbate that generational divide, if you like. At first blush, essentially, the government is taking away from older Australians to give to younger Australians.
Well, that's what they say. Whether or not that actually happens, I question that, because the problem is that the capital gains issues going forward will impact younger Australians just as they do older Australians. And in fact, older Australians or investors who've been invested for a long time maintain their current CGT rules up until July next year. So medium and long term, the impact for younger investors could well be more extreme because they will be investing with the new CGT environment, and yeah, certainly some of the comments about younger Australians trying to save for their home loan will be subject to the new CGT rules if they're investing in other assets in the meantime.
So most immediately, David, what are your expectations for the session ahead? We look globally, sentiment has soured, obviously with negative news out of the Middle East. Also higher than expected inflation in the States.
Yeah, that's certainly right. Yeah, I think that the US hasn't been as concerned about inflation as we have been here. But yeah, the overnight session, those figures had a bit of an impact. So I think, yeah, we are heading for a bit of a negative session today. I don't think, yeah, from a budget perspective, there was anything to be too positive about. So I think that, yeah, probably likely to be a bit of a weaker session today, and yeah, potentially a little bit more volatility and uncertainty given there's no resolution in the Middle East.